Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or grow your real estate portfolio, increase profitability, reduce taxes, and achieve financial freedom. Your host, Seun Adeyemi, is a certified financial planner, mortgage professional, and fellow investor. We want to help you get real so you can pursue your investing dreams with confidence. A real estate acquisition lifestyle is within your grasp. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
I'm your host, Seun Adeyemi. I've got a really important subject for you today, and that is on taxes. Nobody likes to talk taxes, but taxes are a big part of our lives as Canadians, and especially as homeowners and real estate investors. You've got to understand how taxes work. Taxes have a big part in how you structure your estate, how you plan for the future. And you've heard the saying before, a lack of planning. If you fail to plan, then you're planning to fail. And so I've got a guest on here, Mohammed from Tax Heroes, who's going to talk about taxes with us today. Mohammed, how are you doing today?
I'm doing good. Thanks for having me.
Can you tell us a little bit about yourself? I know you run an accounting firm, your designations, how you got into accounting.
Got it. Yeah. So, ever since, when I was in university, I guess, let's start with there. I just Googled, jobs with high paying salaries and, accounting came up. And that's literally why I went in there. No passion, nothing else for it. I literally just chose it because it had a high salary. When I got in the field, I realized that some of those numbers were inflated and the salaries weren't as high. And so I realized one of the ways that you could make a high salary is really from becoming a partner at one of these big firms. And so that was my goal. I joined this accounting firm. I was aiming for partner. And then what I found out is that these guys were really targeting very big businesses, very rich people, and they weren't targeting your average, small business to medium-sized business owner or entrepreneur or professional. And so I wanted to take that knowledge I was learning there and really help people and really kind of bring that value of tax savings to everybody, because a lot of people don't know about this stuff. They don't know that they're paying too much tax, or they can, do simple things to just, wipe away thousands of dollars of tax. And so it eventually actually became a passion of mine. And so I've started my own firm. It's about a year ago, me and a partner, and things have been going very well. I've been really posting a lot on Twitter, so that's like really my main medium. I will probably move to TikTok and YouTube soon, but I'm there not even just to get clients or anything. I just want to educate people, because so many people don't know the basics of tax or simple ways that they can save tax, and I'm just there just trying to show simple things you can do to save tax, and this could save you thousands of dollars a year and really just add up and really build wealth over time just by reducing your tax. So
that's actually how we met. That's actually how we met, right? We met on Twitter, and I love the stuff that you post on there, and you post a lot of valuable content and just different things that Canadians are not aware of when it comes to filing their taxes, and some loopholes which I wouldn't consider loopholes, but with wrong advice, the tax things people try to do. And so I thought, this would be a great person to get on the show. So that's how we actually connected. But talking about real estate investing and taxes and how a big impact they can affect, and how much they can affect your income or even your wealth. The only tax most people are familiar with is capital gains when it comes to real estate. But there's a whole lot more to owning investment properties and owning real estate beyond just capital gains. So let's talk about that a little bit. Explain what capital gains is for a new listener who's trying to understand it, and then we can go into the other types of taxes that consumers should be mindful of.
Got it. And so I guess just taking a step back, when we talk about real estate tax, there are different types of real estate activities, right? So there's,
Mm-hmm.
buying a rental property, which is the most common one and probably what most of your listeners are, interested in. But there's also, flipping properties. That's also a very common type of real estate activity, or even building a property and selling it.
Mm-hmm.
Some people are into, short-term rentals. That's just a completely different ballgame. It's a whole like 3-hour discussion alone just in short-term property. So I guess why the activities matter is because these different activities have different tax implications. And
Mm.
so the main tax implication is exactly what you said. Is the profit from a sale of a home considered business income, or is it considered capital gain? And this is probably one of the most important things to do or to analyze when you're investing in real estate. Will your sale of property be considered business income or capital gain? And so why does it matter? Why does it matter if it's capital gain or if it's business income? Let's say you make a profit, of $150 on a home, right? It's very low profit, but let's just say you make a profit of $150 on a home. If it's business income, you have to include the full $150 in your income, right?
Right.
So you're getting taxed on the whole $150. But if it's a capital gain, you only include 50% of that profit. So you'd only include
Mm-hmm.
$75 in income. And so the difference between the two is significantly different. You're effectively cutting your tax rate in half
Right.
just from getting a capital gain treatment. So everyone's like, yeah, let me just treat it as capital gain then. Why would I treat it as business income? Unfortunately, it's not that simple, and it's not really for you to determine. It's based on, a set of rules and like a set of court rulings and set of guidance set by the CRA. And so, what are the things they kind of look at when determining if something should be business income or if something should be a capital gain?
Capital gains.
Yes.
That
So
was my next question.
the main thing that they're really looking for is the intention. So there's a bunch of categories, but one of the most important things is really the intention. Why are you buying a property? If you buy a property, what's the purpose of you buying that property? Are you buying it to sell for a gain in the future, or are you buying it to earn rental income for just for yourself?
So if I'm buying a property to generate rental income.
Got it. Okay, so that's the good answer. And I'll tell you why that's the good answer. The good answer is because they say your primary intention is to earn rental income, and so the eventual gain will be taxed as a capital gain. Now, if you're buying for purposes of just, flipping it at a later time for a gain, if that's the main intention behind your
Mm-hmm.
purchase, even if you are renting it out, then they say, okay, that should be business income because that's the main purpose. And they also look at other factors. Intention is just one. Frequency, how often you're buying, how often you're selling. You know, uh, just your conduct. Are you listing things for sale? There's a bunch of different other factors to consider when you're doing this, but that is just one of them. Is intention, frequency, and just the conduct and how you're doing things. So that's something to keep in mind when you're selling a property.
So I'm curious to how does CRA determine your intention then? I can tell CRA that, well, I'm buying this property to generate rental income. If I sell it at some point down the road, great. But the goal wasn't to buy it to flip it. But then I buy it. That's my intention. That's what I declare as my intention. But then I decide, you know what, I'm going to go ahead and sell it because it's the property has increased dramatically, and I see an opportunity to cash out. How does CRA determine intentions?
That's a great question, and it is a little difficult to do that, to really determine what is the intention of someone. So they look at like things that can kind of give them sort of evidence on what the intention would be. So for instance, if you're buying it for rental income, but you're just gonna have rental losses for several years, and like next 10 years, sorry, next 5 years you're projecting rental losses, next 10 years you're projecting rental losses and everything like that, then that tells them, okay, why would you really buy this to rent it out if you're just going to have losses over the years, right?
Mm-hmm.
And so that's something to really keep in mind, because CRA is sending a lot of notices now with people with huge rental losses, and they're saying, show us a plan for profitability. And if you don't have one, then this eventual profit on your real estate, if there is a profit on the real estate, would be treated as a business income, because you might be renting it out, but that doesn't seem to be your intention if you're just losing money on rental income. Now, it doesn't mean everybody who's losing money will be have
Mm-hmm.
business income versus capital gain. That isn't necessarily true, but it is something just to keep in mind, and it is one of the factors they can look at.
So for instance, now, I mean, you look at where the Canadian real estate market is, especially in the GTA, where things are crazy expensive. And I buy this $1 million property to rent it out. That's my objective. But then my mortgage on it is $5,000. Let's say hypothetically, especially with interest rates today. But realistically, the max rent I can collect on that is $4,000. So that means I'm declaring a $1,000 loss minimum every year. It is possible for CRE to look at that purchase and say, well, when you purchased this property, you already knew that you were going to run at a loss. And so when you now sell it 3 years later or 2 years later, because of the way Toronto real estate has appreciated over the last few years, CRA may now say, well, you bought it knowing that you were going to lose money on the rental income every year. And then you decide to sell it and then you make this huge profit. There's a chance CRA could come back and say, well, then this is business income because it doesn't look like you really bought it to generate rental income, because you already knew, or at least an investor doing the due diligence would know that that's a loss. Is that kind of where they would view it?
Exactly. So I would say that's a risk. But remember, there are arguments you can make. You could make, you expected interest rates to go down in the future, and so you
Right.
affected to eventually, turn a profit. Or there's different cases like that, right? There's different things to consider like that. Or you're trying to build like a real estate empire, and you expected, this to build equity, so to buy another real estate property. So there are arguments you can make, but I will say
Mm-hmm.
it is a risk to consider, because they have to come up with intention somehow, and they don't have a lot of information on what your intention is going to be, and so
Right.
they have to take on things that they can see, right? And
Mm-hmm.
there are limited things they can see, right? But if like things like profitability, or if you continually list the profit of just to see, if you're going to get the bids at where you want it to be, things like that, then
Mm-hmm.
those give them some sort of evidence to kind of determine your intention.
Mm-hmm. So talk to me about the new rules that came into effect this year, especially when it comes to flipping properties and how that changes for real estate investors.
Sounds good. Yes. So very important new rules that is crazy. It's affecting lots of people, even people who you wouldn't have ever have expected it to impact. And so I guess there's a couple new rules, but the main one is the anti-flipping rules. And so what are the anti-flipping rules? Basically, it's a rule that says if you buy a property and if you sell it within 1 year, it doesn't matter what your intention is. It doesn't matter what you why you originally bought it. It doesn't matter if you lived in the home or not. We are going to treat that income as business income, or we're going to tax you on 100% of the income, right? So there are a couple of exceptions where they say, if you fall into these exceptions for selling a property within a year, then we won't
Mm-hmm.
tax you on business income. And that's like different things, like, if you have to relocate for work, or, for your own safety, or things like that.
Right.
But generally, every sale within 1 year will be treated as business income, even if you lived in the property.
So even if you lived in the property and you own that property for less than 1 year, it is automatically business income. There's no option to even try declare capital gains on it. Before, it used to be that I could own a property for less than a year and sell it and still be able to declare it as a primary residence. That's one side of it. And then the other side is, well, yeah, I agree. It may not have been a primary residence, so I'm going to declare capital gains on it. So this is even much worse than that. So there's no option for primary residence. There's no option for capital gains. It's 100% business income. That's a big deal.
Exactly. Unless you follow one of those like few exceptions. And so I actually had someone, ask me in the Twitter DMs. She was like, I'm selling a property. Just I moved. I bought this house. I just don't like it. Like I want to go back home where I'm from. and so I just want to sell this property. Can I sell it without, like, do I qualify to get out of these anti-flipping rules? And I said, no, you don't. That's not one of the approved, like, exceptions of getting out of the rules. So you should probably just sell it after 1 year, so that you can just at least get a capital gain treatment
Capital
at the
gains.
worst. Yeah. And then, so it's not automatic. It could still be business income. It doesn't mean if it's more than 1 year, it's not business income. It could still be business income, but you just have a stronger case that it's not business income, right? It's not guaranteed business income. But she lived in the property, and she seemed like, and it was her principal residence and everything, so she should not pay any tax when she sells that home.
So in essence, what you're saying now is, okay, so 100% if it's within the first year, it is business income. But after the first year, it's at that point the intention now comes into play to determine whether or not it's capital gains or primary residence, right?
Exactly. Yes.
So I think this is really important, and especially for investors who are very much into flipping properties, fixer uppers. That makes a big difference, because now you put in $125,000 into a property, and you make an extra $130,000. The whole $130,000 gets taxed. And so the age old question many people have asked me in the past was, if I'm going to be flipping properties, then does it make sense to own the property personally or to own it through a corporation, especially with this new anti-flipping rules?
Yes. Beautiful question. And it's amazing because it does get you thinking. So generally, when it comes to real estate, like, when it comes to anything in tax, the answer is always it depends.
Right.
There's almost like no one set of answers that applies to everybody. And generally, the rule of thumb in real estate is that you shouldn't put your real estate in a corporation. Now,
Right.
there are exceptions, right? And this is exactly the question you just asked me is one of the exceptions where it does make sense to hold real estate in a corporation. And that's if you're flipping properties. If you know you're going to earn business income from your property, then it makes sense to hold it in the corporation. And so, why would it make sense to hold it in the corporation if you're earning business income? It's because your corporation can pay, depending on the province you're in, anywhere between 9 to 12% tax on its business income. And if you earn business income individually, like as a sole proprietor, then you're paying up to, depending on your province, right,
Hmm.
54%, up to 54% on your personal tax rate, on your business income. And so you have a huge ability to defer tax if you're earning business income in a corporation. Now, should the person who buys a rental property, who doesn't already have a corporation that they're earning business income from, should they buy that rental property in a corporation? The answer is usually no, unless they're very, they really want to avoid liability, personal liability, and even then there's still insurance and stuff. The answer
Hmm.
is usually no. Again, depending on the situation, but the answer is usually no. But a person flipping homes, earning business income, that's a good use case for actually holding it in a corporation.
Before this rule came in, I'm a proponent of owning your real estate personally, because income you generate, for most Canadians, you'll be getting taxed on your marginal tax rate. And so depending on whatever income you earn from your job, even when you add that income, the capital gains income, there's still leeway, there's still room that you may end up paying less taxes when you own it personally than if you own it corporately. But now with this new business income anti-flipping rules, what that does really is, and I think this is even more so not just for rental. I think the case of whether to own personally or own corporately will be determined by what's the intention for the property, right? If the intention is to rent it out, then maybe you could make an argument that even after they add that rental income to their personal income, their marginal tax rate may not be that high. But if the objective is to flip that property either within a year or to generate business income with it, then I think there's a stronger argument to be made now that could be owned corporately, because I buy a $600,000 property. I spent $150,000 renovating it. Now my ACB is $750,000. I sell that property for $900,000. That $150,000, if it's taxed within the corp and taxed at the lowest marginal tax rate, 13% or 9%, depending on the province, then there's a chance that I could leave those profits in the corporation and reinvest it without having to pay personal tax on it. Otherwise, if I own that property personally, that $150,000 gets added to my personal income. So let's say my personal income is $100,000. So all of a sudden, I'm getting taxed on $250,000 income. That's a higher marginal tax rate of 30-40% as opposed to 13%. So there's a big argument to be made that because of the anti-flipping rules, if the objective for that property is to flip it within a relatively short time, then it should be owned corporately.
Exactly. No, yeah, I think exactly. And I'm gonna just take that clip out and I'm just gonna send it to my clients next time they send me that question. But I did want to clarify that even if it's gonna be owned for more than 12 months,
12 months?
right? And the flipping rules won't apply. If you're really flipping properties, that is still considered business income. So
Right.
even if it's if it's held longer for more than 12 months, I would still do it through a corporation. Because you're still going to benefit because it's still business income and you're going to still benefit from the low corporate tax rates on that business income.
Right. Okay. That makes absolute sense. So if the goal is rental income, there's an argument that could be made you can own it personally. But if the goal is business income and there's going to be flipping, whether that's within a year, 2 years, 3 years, 5 years, there's a big argument to be made that it is better to own it corporately. There's a whole lot more I want to talk about.
We can go on for hours. There's so much to talk about in real estate.
I'm just wondering if we have enough time. Let's talk about deductible expenses. Current expenses, capital expenses. We just talked about flipping, and when people are flipping, they usually put in money into the property to generate either rental income or to generate profits at the end of it. So talk to me about what expenses can I deduct and in terms of the categories they fall into.
Yeah, so I wish I had some, special deductions and everything, but deductions there aren't a lot because the general rule for deductions is whatever is laid out to earn income and is reasonable, you can deduct it, right? And so general things you can deduct are mortgage interest, property taxes, right? This is if you're renting out a property. Maintenance fees, if you're paying for utilities, repairs, and things like if you're advertising the property, if you're paying a property manager, these are all deductible fees. But I think what's more important is actually what's not deductible, because there might be things that people are deducting that they shouldn't be deducting, and I think that is a more common discussion than what am I deducting that I'm not what is a deduction that I haven't taken advantage of that I should. Usually people try to take advantage of everything and they're good at identifying everything, but what they usually, the missing part is really what they've deducted and what they shouldn't have deducted.
Deduct.
Exactly.
Examples. Give us examples.
Perfect example is your whole mortgage payment. So let's say you're making 60K mortgage payments a year, and 40K of that is interest, 20K of that is the principal, right? People sometimes think, oh, because I'm spending 60,000 a year on my mortgage, I can deduct the full 60. But you can only deduct the interest. Yes, I wish. I would have bought like 4 or 5 properties already. You can only deduct the 40K of mortgage interest, right? And so that's a common mistake that people make. I think something you alluded to right before it was just the current versus the capital expenses. Yeah, and so that's typical when you're kind of spending something to make a property better. For instance, let's say you're renovating the floor, right? Getting new hardwood floor and everything. That is something that needs to be capitalized and depreciated over time versus expensed, right? But if there's an issue with the floor and you're repairing the floor, that is something you can expense in that year, and that can be 100% written off in that year.
You use 2 words that I want to kind of dig a little deeper: capitalize and depreciate. Can you explain what those are? I understand what it is, but for our audience.
Yeah. No, for sure. So it's kind of when someone's buying a property for the first time, right? It's kind of important you understand at least depreciation, capitalization, what these things mean, because they're very important when you're dealing with real estate. And there's a lot of like random rules that you kind of have to kind of know just to better understand your tax situation and how buying a rental property affects your taxes, right? And so like you mentioned, depreciation, you see these in personal finance books, especially, US based personal finance books like depreciation, save you tax, depreciation this, depreciation that. And you're like, oh my gosh, you read these books like Rich Dad, Poor Dad, which, it was a great book growing up, so no complaints there. But you hear about these US tax concepts and you're like, oh, I'm going to do that. I'm going to just depreciate, never pay tax again. And, I'm okay. I will never pay a dollar of tax in my whole life. And so it's really important that you actually understand how depreciation works, especially in Canada, and what it is, right? And so I don't really have a good definition of what depreciation is. Maybe you actually could describe it better, but the way I see it is expensing your building over time and your other property over time.
Yes, if I take the word, the little meaning of the word depreciation, it means that my property, in terms of the value, it's as I use it, the wear and tear on that property is being used up over time. And so a portion of that wear and tear is what I can deduct against the income in that year. And so CRE allows me to deduct wear and tear. So let's say my property, I bought it for $500,000, and and you know this, there's a formula used for equipment versus building, and there's different calculations that are used. So a certain portion is deducted by X amounts. So I think one of them is 20%, one of them is 4%, or something like that.
Yeah.
And so it allows me to essentially, as I use the property, I write off some of the value against the income I'm generating on the property. The flip side is that if I've depreciated my property that I purchased for $400,000, and over 5 years, let's say I've depreciated it by an additional 20, 30,000. So now the book value is 470, so 30,000, let's say. But I turn around 5 years later, I now sell that property for 600,000. Rather than paying capital gains on the difference between purchase price, which was 500, and 600, which is $100,000, what actually happens is that 30,000 that was initially depreciated gets added back to my regular income, and then from 500,000 to 600,000 is what I then pay the capital gains on business income. Am I right in how I describe that?
You literally could have. I'm gonna take another screenshot or screenshot of this video, and I'm just gonna send that because that was actually a great. I'm writing notes right now just so I explain it in that same way. That's very well said. And I think that's exactly a great way to describe it. But I think where where people kind of get mixed up here is there's a couple like rules that you know an average person might not know, right? And even I see accountants making these mistakes all the time, and it's just something to be mindful of, right? So one of the most common issues I see is when someone buys a rental property. So let's say you buy a property for $100, okay? You have to allocate a portion of the property to building and a portion of it to land, right? So
Right.
based on the value of the building versus the value of the land, you take its proportion and then you assign it. And
Mm-hmm.
yeah, no one really acts like let me just step back, and what I'll say is I haven't seen any clients actually get a valuation to determine the split. They typically
Right.
use rule of thumbs, right? Like, oh, maybe
Mm-hmm.
20% land, 80%
Mm-hmm.
building, or whatever the case. Technically, you're supposed to get a valuation. And so why that's important is because you can only depreciate the building and the other things like you mentioned, equipment, furniture, things like that. You can't actually depreciate the land. And so
Mm-hmm.
sometimes you will get, let's say, the $100 property, and you think, okay, building can be depreciated 4% a year, so I'll claim the 4% each year. You're actually depreciating more than you can because you haven't done the land building split, and so you're actually depreciating the land, and that's something to be mindful of when you
Mm-hmm.
do have when you do buy a rental property to determine what the land building split is.
Right.
um, And just I guess one other thing is that you cannot claim depreciation to create a rental loss. So let's just say uh, after your rental income before depreciation is 10,000, but you can claim $30,000 of depreciation based on the calculate, based on the 4% that they take, right? You can claim
Mm-hmm.
$30,000 of depreciation. I can't create a $20,000 rental loss, right? I can only use enough depreciation to bring my rental income to zero, right? So I
Mm-hmm.
have $20,000 that's not used, and that goes back into the pool, and then next year I can claim 4% of what's remaining on that pool, uh,
Right.
in the future year. So I think those two things are two very important things to keep in mind when you're thinking about depreciation.
Absolutely, especially because you can't create a loss with it. You can only bring your taxes to zero if your rental income to zero, and then you can carry it forward for future years. Um,
Exactly.
I think we've covered a lot. This is a conversation we can probably go on and on and on about because there's a little nuances to many things. When people ask me financial planning questions and they want rule of thumbs, and I always say it depends. And taxes is one of those. Taxes is also one of those things that it depends.
It always depends. It always there's nothing that's straightforward about taxes. It always depends.
And so I always that's why I always say, you know what, seek advice that's specific to your situation, pay for the right people to kind of help you out, and give you the advice you want or the advice you need to save you on taxes and save yourself some headache, because sometimes you misclaim things. CRA can come after you, and man, that can be hard to try and go after CRA and say I don't owe this amount of money. It can be daunting, and it can cost you a lot of money. So sometimes it's just best do it right the first time so you don't have to worry about it.
And just to add to that point, I think this really speaks to why you want to work with a financial advisor, or you want to work with an accountant, right? Because there are so many in maybe just in these past 2 years, there have been so many new rules. Anti-flipping was just one of them. There's, vacant tax. There's something called
Mm,
underused housing tax, and you might have to file a return, and if you don't file a return, it's a $10,000 penalty. There is, these new trust rules which could apply to people who might not even think they've had to file a trust return. And so there's all these new rules that are coming out and changing, and it's already difficult for financial advisors and accountants to keep up with these new rules. And just for the average person, it's going to be even more difficult because they're not seeing
hmm
this on a day-to-day basis. So it just speaks on why you should work with a financial advisor, why you should work with an accountant on these things, rather than try to do it as much as of it
hmm
as yourself.
I think some of these topics we've gotta hold them and have another conversation, have an encore of this. This has been really helpful.
I
Before
appreciate
we
that.
before we wrap up, can you tell our audience if they want to get a hold of you, what's the best way?
Sure. On Twitter, that's literally the best way. Better than email, better than anything. The Tax Heroes, at the Tax Heroes, that's my thing, but I go by the name of Canadian Tax Guy. That's literally the best way. DMs if you have questions, or follow me, or just send me a tweet. I'm always there. That's how I'm most responsive. You can also email me, Mohammed at taxheroes.ca. And then lastly, we have a website, taxheroes.ca, and you can just put a submission there, and that goes through our whole sales funnel, so you'll see everything.
I will leave Mohammed's contact info in the show notes. Thank you very much, Mohammed, for joining us today. This has been awesome, and will be having you back on the show.
For sure. I appreciate that. Thanks for having me.
My pleasure.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook at True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms, or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.